Hello and welcome to the Wild Bat Podcast. You are tuning into episode 12. We are looking at the Income Tax and CCPC course. This is Module 9, discussing change of control. Corporations can be purchased and sold via their shareholding. This includes voting rights, which can be sold when a shareholder acquires the shares. When we're looking at changing of control, there are a few tax treatment that has to occur when we're looking at what happens to certain estimate accounts, such as inventory, fair market values, doubtful debts. Also, we need to consider the concept of carry forward losses, both capital and non-capital. You might want to go back to Module 4, determining whom has control. This is not limited to who owns the voting shares, but more so the voting rights, or if there is a concept of change of control due to a contract that's been put in place, such as a supply contract or a franchise. When a change of control does incur, then we do have these tax obligations, tax activities that are going to incur. Looking at section 256 part 7, it is going to take into account other factors in which there are specific situations which can be exempt from the change of control concepts we're going to discuss. This is death, amalgamations, the main concept we're going to look at this podcast is going to be loss pools, and how under subsection 256 part 1 there is loss pools that are available, in which we don't want to change the control, because as we're going to discuss later on, we want to defer the change of control because the losses will be subject to a loss restriction event. This also comes into effect when we're looking at subsection 251 part 2, where trusts get involved, where trust interests can determine whom is in control. What generally happens when a change of control does incur is that a deemed year end is triggered under subsection 249 part 4. The reason this is incurred is because we wish to, when the deemed year end occurs, there is stop loss events and loss restriction events, and also other activities which have unique tax treatment and must be reported as such in order to determine what the new adjusted cost base will be for the new owner or the new controller shareholder, and what will happen to the prior shareholder who just lost control. There's a big list here. When there's a change of control, we'll just go through a few of them. The first one is inventory losses. These, when inventory can either be valued at cost or fair market value. However, on a deemed year end, it is the lower of this amount, and the inventory losses must be recognized in the prior year. Let's go back a scenario. So throughout this section, we're going to be looking at this timeline where there is year 1, which is going to be when the prior shareholder had control, had losses incurred and carried forward, and then year 2, in which there's a deemed year end, finishing year 1, and year 2, which is the start of the new controllership, in which we have to determine if any capital losses are going to incur, what the ACB or activity adjusted cost base is going to be on certain assets. So remember, year 1 is for the prior, year 2 is for the new owner. Doubtful debts. Any doubtful debts recognized in year 1 have to be declared as bad debts. And then so in year 2, there won't be any doubtful debts adjustment. The capital cost allowance, there are going to be restrictions on such, in which it will be adjusted in the second year. The same goes with the scientific research and development expenditure, that the limit on the use of deductions will be impacted as there's going to be new controllership. Tax accounts such as GRIP, LRIP, the capital dividend account, and net capital losses all have certain tax treatment. Generally, these all get nullified, meaning that the new controller does not get to enjoy any prior year 1 losses. Non-capital losses have different tax treatment. We're going to discuss that further on. And investment tax credits generally do have adjustments as well. Stop loss rules are rules in which limit the amounts of, or either extinguish or limit the amounts of capital losses or non-capital losses in which can be carried forward to the new controlling owner. We'll first look at capital. As discussed, capital losses cannot be utilized after control has changed, so the new owner does not get to enjoy any capital losses. These capital losses can be hidden in the actual property owned by the corporation, in which they are defined as pregnant losses. This is when the adjusted cost base is greater than the fair market value. Under subsection 111, part 4, part C and D, the capital property has to be reduced to fair market value. An example of this is, just say there's a corporation. We're going to use this corporation in the future again in another example. A corporation has one building, and the building is worth $1 million. The building has an adjusted cost base of $1 million. However, its fair market value is $800,000. Upon change of control, the new adjusted cost base will be reported at the lower of adjusted cost base or fair market value, meaning that because the $800,000 is less than $1 million, the new controller will have to report on the corporation an adjusted cost base of $800,000. If it's the other way around and the fair market value is greater than the adjusted cost base, under subsection 111, part 4, part E, an election may be triggered. An election may occur in which you can trigger a capital gain by increasing the adjusted cost base to anywhere between the adjusted cost base and the fair market value. We're going to go through this on an example on the next slide. As a result, a capital gain gets incurred, but the value of the assets, the adjusted cost base of the assets, does increase. Another point to consider is that if the proceeds that the new shareholder has purchased the corporation for is less than the corporation's capital cost, then a depreciation recapture may be incurred, which the prior shareholder may be liable for any depreciation recapture. Generally, all of this is defined, all of this is done at the deemed year end in order to determine what the capital gains and losses account is going to be. Any carry forward losses are going to be determined. And then also it's going to calculate what the capital dividend account balance will be in which a capital dividend can be elected and to the prior shareholder, because that account will not carry forward to the new controller. All right, now I'm going to move over to IVPO to discuss an example of a control transfer. So we're going to look at this corporation here, following on from other examples we've used previously. A person owns one co, and it's going to be sold to another group in which control is going to be changed over. So right now, OneCo is a pretty simple organization. It has adjusted cost base of 2 assets. Buildings value at the adjusted cost base of $1 million and land at $1.2 million. Due to certain changes maybe in the market or other parts of the components that make up the building and the land, the fair market value is different. The buildings have a fair market value of $800,000 and the land has a fair market value of $1.5 million. So as you can see here, the buildings have a pregnant loss of $200,000, as if the building was sold, then there'd be a loss incurred. Before we move on, another thing to mention is that there's a carry forward capital losses from prior year of $100,000. Taxable capital losses, which carry forward. So as before, under section 111 part 4 C and D, the adjusted cost base has to change to the lower of the ACB or the fair market value. And in this case, it is going to be the fair market value. This will trigger a capital loss of $200,000, and $100,000 of that will be taxable. Land is a different story. It has a lower adjusted cost base than fair market value. It can, if it wishes, declare via election under 111 Part 4E to elect an amount between the adjusted cost base and fair market value. What we want to do is use up the capital losses. If nothing else is done here, then the capital losses of $100,000 plus the one that was incurred on the buildings at the deemed year end is $200,000 of taxable capital losses that are going to be extinguished. The new owner is not going to be able to use. So the prior owner can make the selection, and if it increases the capital gain by the $200,000, actually no, it's going to have to increase the capital gain to the maximum of $1.5 million, then it's going to result in a $300,000 capital gain, which only $150,000 will be able to be a taxable capital gain. As a result, it can extinguish almost all of the capital loss that has been incurred, so 100% of the prior year and half of this. So there's still $50,000 worth of capital losses that are going to be lost. However, it's going to use up most of that, and it's also going to create a capital dividend account adjustment of $150,000 worth of capital dividends that can be incurred and provided to the prior owner. The new owner is going to have an ACB for its new assets of $800,000 for the building and the land of $1.5 million, which is a total of $2.3 million worth of capital assets on their new balance sheet. Depending on if they had purchased the new company shares at greater or lesser than this $2.3 million fair market value. If it was greater, they would recognize a component of goodwill. If it was lesser, they would recognize a bargain on purchase. We'll discuss those concepts probably at a later date and how they're taxable. Stop loss rules for non-capital or farm losses are extinguished unless upon the change of control, it continues to carry on the similar or same business type that created the loss. For example, if I had purchased a car dealership and it had some non-capital losses, I could use these as the new controller and new shareholder if these non-capital losses were incurred for selling cars and I continue to sell cars. If, however, these losses were incurred for other activities such as car detailing, mechanics, basically anything else, then the non-capital losses will be extinguished once the change of control occurs. There also has to be a reasonable expectation of profit, which in New Zealand we call it the Greaves test. Here we just call it the profit test. The only other thing that the prior shareholder can do in order to use up non-capital losses is under Section 111 Part 4E is to trigger a capital gain, and if there's no capital losses, then they can use non-capital losses to balance out and utilize the non-capital losses. Noting that this would trade in the non-capital losses for an increased adjusted cost base for the new shareholder, which, as we've discussed, would either result in a gain on purchase or a goodwill adjustment. Okay, thank you for tuning in. That's all from me. We're almost finished, only 3 more to go. Module 10 is going to discuss owner and manager remuneration. This is going to be 3 components of this. We're going to discuss salaries, and then we're going to discuss certain benefits, and then loans to the owner or manager. Thank you, and have a very good Thanksgiving.